Welcome, everybody, to this week's episode of Generational Gains. Today, I'm going over another deep topic in the life insurance space. As you guys know, I teach infinite banking. I teach insurance strategies. I teach cash flow management. I show individuals how they can use life insurance as a savings, banking, retirement, investment vehicle, to put it short. Now, those of you who have not learned about these strategies or this policy yet, please don't watch this recording or this podcast. Go and check out another recording or webinar of mine where I teach this strategy more in depth and kind of the basics of this. Today's gonna be more advanced. We're gonna go in deep around policy illustrations. So how do you actually look at and dive into a real illustration for a policy? Again, those of you who don't know what that even means, go move on from this episode, go watch the presentation. In terms of this policy illustration topic today, what I want to talk about is it's a tough conversation because there's so many things to look at when it comes to a policy illustration. And for you to fully understand what's happening inside the illustration and how you can actually put all the numbers together in the proper perspective, it's very difficult. I'm Carson. I help people make sense of money and I help people make sense of life insurance. So today, let's get into that topic. Now, a lot of people want to see the numbers when they look at an insurance policy. And I understand that. They should want to understand the numbers. They want to understand, what does the product look like? What's the best product to use? What do these policies actually look like? All very good things you do really want to understand. And also, they think that policy illustrations will tell you what company is the best to work with. And unfortunately, once again, it does not do a very good job of doing that. I actually downplay illustrations. I don't think illustrations actually mean very much. Some people treat it as the gospel and all their decisions are based upon the numbers. I think it's a terrible way to look at life insurance. Understanding the product design and the company is way more important than the illustration. So I'm going to get into that today. We also think a lot, though, that at times that maybe policy illustrations sometimes show what company actually thinks the policies are going to do in the future, like it's a projection of some sorts. That's actually also not the case. That's not what they're trying to do with an illustration. Sometimes they look at a policy illustration and they think it's going to show exactly what's happening next year, 10 years from now, 30 years from now. Not really the case. What the policy illustration shows is what's happening today, right now. They're not really trying to say that you should expect it to be this exact way in the future. It's a lot of things that are outside of their control that will determine that. So they're not going to show you that or try to sell you on some high upside of the product. A lot of it has to do with interest rates, environment, bond market. And the number one flaw with looking at this, which we have to keep in mind the entire time when looking at illustrations, is that whenever you're trying to implement the infinite banking concept, or banking with life insurance, or family banking, or the safe method, whatever you want to call it, an illustration does not show you what it's like to implement the policy. All it does is really show you, if I pay a premium, what kind of cash value do I receive? And what kind of death benefit do I receive? And this is where things get derailed the most easily, is when people essentially use the illustration and they look at the numbers and see if the numbers are good enough. Like, in other words, they're looking at this as an investment. Are the numbers good enough for me to actually do this? Or should I do something different with my money? And what we're trying to say is, remember, you're not using the policy as an investment. You're using the policy to build a banking system, to build a process of cash flow management. That system can be used to fund other investments, but this itself is not an investment. And so the question then lies before us all. Do I want to build a banking system? And if you do, then you decide to do the policy. If you don't want a banking system, you don't do the policy. But the illustration should not make that decision for you. The illustration does not teach banking whatsoever. It's just a product. And then number two here is, what's the best way to build a banking system that I'm in control of? And we feel that infinite banking and becoming your own banker presents through these policies the best route. It's not saying that the banking system is the investment. It's saying it's the best place to do banking in. So let's go ahead and actually dive into an actual illustration today. The goal of this episode is to really share what I think, first off, how to read an illustration. And I think it's very important, at least that how to read it. And then secondly, you really want to get to the point of getting to the proper perspective when looking at the illustrations. And so what are the real things that I'm trying to gather when I review the illustration? That's the question you want to think about. So what I do, and what I did today, is I kind of built a basic policy illustration. I didn't do a whole lot of odd things with it. It's just super, super basic. Not that I normally do, per se, a super basic policy for banking. It's just the basic scenario for the example of today's episode. And so I'm not going to share my screen or show you it today. I'm just going to kind of read through kind of what it looks like. But if you have seen an illustration, if you're listening to this podcast, I probably sent this to you, honestly, to better understand how illustrations should be looked at. And you probably have an illustration you're already looking at while listening to this podcast. And so if you have an illustration in front of you, or if you have seen one recently, or you're looking to get a policy and you want to know what an illustration looks like, what it looks like is it has a ton of columns on the page. And obviously, if you're listening to the audio here, you're not going to see me with my hands and everything like that. You're not going to see the illustration. You're just going to kind of picture this in your head. But there's a ton of columns on this chart. And it's a huge wall of numbers. And so when we do infinite banking, we don't care about very many of these columns. The key numbers that we care about are what are the premiums I'm contributing? And then you'll see a premium column on there. What is the cash value that's accumulating in the policy? And then you can kind of see the cash value as that column on there. And what we want to understand and realize is the fact that we do have a death benefit on this policy. We do have coverage. We're not going to accentuate it or talk a ton about the death benefit because it's not usually the main reason we set it up, but it is important. And I think many people underplay a lot of times the death benefit and the importance of it. So really, the numbers that we're focusing on this page are the most important ones. How much money am I putting in? What cash value am I getting? And what's the death benefit I'm paying for? So in a basic policy example, these numbers, again, it could be anything you want. It could be $10. It could be $1 million. You pick the number. We've done all of the above. I'm just going to use a simple example of 50 grand. Let's just say you put 50 grand every year inside of your policy. Now, what does a 50 grand policy mean? Does that mean the death benefit's 50 grand? No. That means that we're going to be putting in 50 grand every year. That's the essential premium per year. And so inside of every policy, there's actually kind of a window being created that you're allowed to contribute towards. At the top of the window, the max premium you can pay into the policy every year is going to be your MEC limit. Summary, if you don't remember what this is it's the modified endowment contract rules. It's essentially a cap you're able to pay into your policy every year. And if you exceed that cap, the IRS will start looking at your policy as an investment and no longer a life insurance policy, and they will start taxing you on your gains. Now, we do not want anything to do with that, or the IRS. We want to stay in that tax-free environment, and so the way to do that is just never put in more than your MEC limit. So again, there's a window of how much you can put into the policy. The top line is your MEC limit, and the bottom is what's called the base premium, the regular whole life premium that you're paying. And how we fill up that window from the base premium to the MEC limit is through your paid up additions rider, or your PUA premium, which is completely flexible premium on the policy. And what's really nice about policy illustrations is that we can actually see what's happening in real time. So in this example, let's say someone was contributing 50 grand a year, right? They're just maxing out the MEC limit every year. And the goal would be, if at all possible, to try and max out the policy every year to fund up to your MEC limit every single year that you possibly can. And that's always very important. And I like to take the time, especially when I'm reviewing policy illustrations for everyone, to understand that just because we're showing somebody contributing 50 grand a year for a period of time actually does not mean they have to do that. So the interesting thing about bringing up a policy illustration is we can essentially illustrate any amount of money going into a policy, but you're not actually required to follow your original illustration you start the policy with. There's no requirement at all. The paid up addition premium is totally flexible. You are required to pay the base premium. And so in this policy, with the 50K max premium, I think the base premium was somewhere around 16 grand a year. So 16 grand a year is your minimum, 50K a year was the max, anywhere in that range you could pay into, and anywhere above that 16 grand would be all paid up addition premium. That would mean 34 grand a year would be paid up additions. So if 16 is the base, 34 is the PUAs, 50K is the total max premium. Easy math, right? So what I want to bring up with this is, just because we're showing someone putting in 50 grand a year, we always have the ability to go back down to the minimum of the 16, right? So once a policy really matures, and it's doing well, meaning the base premium is giving you a ton of cash value as well, not just the paid up additions building your cash value. But if the base premium, the regular insurance premium, is building cash value quickly, you're at a pretty efficient point in the policy, and you may not need to put in more paid up additions. Maybe you want to use your PUA premium to go fund a new policy on somebody else. And you're not required to do the full PUAs every year. You're not required to stop at any point either. And so I certainly can do whatever you want to do, and that would be kind of the goal, is kind of max out your premiums as much as you can every year to get to the point where it is efficient. And usually it gets to an efficient point around year 5, 6, 7, somewhere in that range. And from that point on, PUAs are totally optional. Maybe you use that money to go do a new policy. Maybe you want to keep max funding this one and keep using it, whatever you want it. And so a lot of the time I end up showing you an illustration where you reduce the paid up additions after usually around 7 or 10 years, just to show you what that looks like over time, just paying the base premium. But anytime we're trying to launch a policy and really build a brand new policy, we need to contribute, if possible, up to the max, up to the MEC limit every year to really build the cash value and get it profitable quickly. So we wouldn't want to start a policy if we knew there was no way that we were going to be able to contribute the full premium every year. If you set a big MEC limit and never paid into it every year, you're kind of screwing yourself. We want to make it a wise policy, make a wise decision with this, and build the policy where your MEC limit, your max premium with all the paid up additions, is essentially what you're going to be able to do every year. If you need to lower it for some reason, you have the option to do so, obviously, but we want to really max it out every year if possible. So once we get the policy fully capitalized and we're really funding it every year, it actually doesn't matter if you just pay the base premium or the max. Policy is going to perform very well from that point on. And so you'll see on a policy illustration me dropping it to just the base premium after a certain amount of years. But things start to go really well after that point. So it doesn't matter, it doesn't need a whole bunch of PUAs after that point. It can perform well with or without them. And so they're not really as important at that point because the cash value is so strong. So that being said, what we need to then look at from there is we need to know how to typically look at the trajectory of the policy, I guess you could say. This is a fundamental, important piece of that policy illustration, is kind of the trajectory of it. And remember, this illustration actually doesn't do a very good job of telling you how the company is going to perform over the next 50 years of your life. It doesn't show a very good job of telling you what the policy is going to perform over the next few years. It's not meant to perform for you. It's meant to just show you the basics. And so it's not also good to show you how you can implement the concept of IBC. It just doesn't do that. It doesn't even do a very good job of describing what the dividends are going to be. We don't really know because some of that's outside of the insurance company's control. But what it is really good at presenting us is a typical trajectory of the policy in general. And you can kind of get a good baseline idea of what that looks like. So back to the illustration of putting 50 grand a year into the policy. You will see on the illustration, it shows you how much cash value is available in year number 1. On this example, I was building it in the 50K premium per year policy with 16K as the base, 34K as the PUAs. The cash value in year number 1 showed about $31,000. Again, this is just an example. So that means in the 50K you put in, you only had access to 30. So there's a lot of different ways to build a policy. So do not take this as like the main only way to do it. I'm just showing you one simple example that's a very basic policy. So some things always remain true when designing the policy, no matter how we structure it. But what does remain true is the base premium does not produce cash value. Early on in a policy, the majority of cash value comes from the paid up addition rider. So that's why the policy needs those PUA premiums to really launch the cash value. And so if you pay just the base premium in the early years, there's not much cash value that comes from that. And we always liken the policy to starting a business. And it's what we kind of liken to when we talk about capitalizing a business. We don't expect the business to be making large amounts of profit early on. Businesses take years to build up and become profitable. We're building the policy for a lifetime of profitability like you're doing with a business, not just for a short-term profitability focus. This is a long-term trajectory. So what's very important to understand when you get it started is, of course, hopefully you know this, before you even see the illustration that I show you or I talk about. I do not expect all of my premium in year number 1 to go into cash value. Never do, never will. It's not possible. I also don't expect that to happen in year number 2. And so in year number one, when you put in 50K, you have about 30K in cash value to work with. So people think by reading or watching videos or lessons that we can't use policies early on, which couldn't be further from the truth. That's actually the one thing that we learn while looking at policy illustrations, is that in year number one, it may not be profitable yet, but the policy is not growing by much yet. It's still capitalizing and building. But I have 30K in my policy cash value to work with. So you could take a 30K policy loan and go start practicing the concept of banking. Maybe you go buy a rental property. Maybe you pay down some debt. Maybe you let it sit there and build up for future retirement. Whatever you want to use the savings vehicle for and banking vehicle for, great, use it for those purposes. But you do not need to wait years to build cash value and access the money you put in. It can be used right away. And one of the biggest downsides, I think, of looking at an illustration is that when people get into investing and they look at it as an investment, they think as far as the policy goes from an investment standpoint, how is it going to grow over time? Oh, I don't have access to all my funds in year number one. That's a bad investment. Well, you're right, but we're not looking at this as a year one investment. This is a long-term strategy. And the reason we're using the policy is because it's a safe place to store money over time, as opposed to the best place to practice banking anywhere else. A savings account, a 401k, a CD, an annuity, a bond, any other sort of savings liquid vehicle. Well, a policy is much better. And so what are you going to do with the cash value becomes an important question when it comes to this strategy. So we need to remind ourselves of that as we're seeing the illustration, is that the goal is to build a profitable banking system that finances our life. Fundamentally, we can't show that on an illustration. All we can show is what happens if I just let the money sit here and don't do anything. So understand that in year one, if you put in 50 and have access to 30, we expect that you use as much of that as possible to go invest or go bank with it. We don't know yet for sure what we're going to use it for. Maybe you do if you're in your policy, but it's just different for everybody. And so year two, it's honestly pretty similar on the illustration. The base premium really doesn't produce much cash value. And so the cash value comes from the paid up additions early on. And that's not the way it always works, but it is for the first couple of years. So in year two, 50K premium goes in. Your cash value increases by maybe like 35 grand, maybe 40. So the cumulative cash value is now 30 grand from year number one, about 40 grand from year number two, total of about 70K in cash value. About 40 grand in year number two of cash value is created. So it's still less than the 50K in premium you paid in. And so now you have a little more cash value to work with, to go invest with. And maybe you're thinking, you're tired of feeling like, maybe, and when looking at an illustration, you're thinking 2 years in, you're tired of not having access to all of your money. But then year three rolls around, and this is where the base premium starts to build some cash value. Sometimes you'll see it in year 2 or 4, depending on your age and things like that. But most of the time around year 3, your base premium will give you access to a ton of cash value. And so in year number 3, what we're gonna see on this illustration is that you pay 50K in premium and the cash value increases by 50K. That means you have access to 100% of what you just paid in that year alone. So what is the illustration good at? Showing the typical trajectory of a policy. Now we're not totally sure again of where the dividends will be or how the company will perform, but an illustration can't show us the exact numbers 5 years down the line, but it can show you relatively close what's gonna happen. So what we can expect, especially in the short term, is that the policies are gonna be pretty accurate as far as building out a typical trajectory. Like what does a normal policy build-up look like from company to company? And where they always look about the same between company to company. In year 3, we get kind of a point in which you start to gain some steam in the policy. You start to build some pretty quick cash value. And then year 3 and on, it just gets better and better. In year 4, you put in 50K in premium and your cash value increases by more than the premium you've paid. So you now have a profitable policy. You put in a premium, have access to more than what you put in, and every year the rest of your life, it will continually compound interest and just get better and better forever. It's not an understatement. It's a guaranteed contract. It will have to get better forever because it's guaranteed to grow. So after the first 2 or 3 years, you've paid your dues, you've built up the policy, you've capitalized it, you now have a mature policy, you're crushing it, you're efficient, and you're gonna have access to more than what you put in every day the rest of your life. And so I wanna talk about that because you really wanna build up the cash value the first few years so you can build up you wanna pay more premiums as much as you can in the first few years to build up the cash value. And you can still use the money, but then once that cash value is built up, you can toss the PUAs off the premium and just build with the base premium and just keep using this policy for all that you do in the future. So another thing to look at with the illustration now is Look at 10 years down the line, 15 years in the line. If you just paid the base premium, example in this scenario was 16 grand. I think in the illustration I was looking at the sample, the cash value in year 15 increased by $50,000. So hold up, think about that. You put in 16 and you grew 50 grand that year alone. You can then take that 50 grand and go invest it in a new property. You have your money tripling in that year, you bought a property, and you have a death benefit while you do it. Long term, this policy gets super efficient as a banking system, and your entire life, the better and better it gets. And the death benefit will actually continually increase every single year of your life, and so will the cash value. It's guaranteed in the contract. So we want to emphasize that this policy is built for a long-term savings and banking vehicle. And we do feel that these are probably the greatest reservoirs of capital that produce steady, consistent growth that we can pull from to produce tax-free income. Mentally, when we look at this, I cannot use an illustration to determine what company is the best company. You can never do that. It doesn't matter. The illustration can be whatever you want from every company. The illustration doesn't teach you how the company makes profit, how the company's using the policies, and how they're investing and their expense ratios. You can't determine what company to use and what's going to give you the best dividend over time based on a silly illustration. It doesn't show that. All you can understand is how the product's designed, which your minimum and maximums are, how much the cash value will grow by, when your break-even and efficiency point is, and how the death benefit is protecting you. And if we need a bigger death benefit, we can do things to supplement that as well. So, to wrap up, this is not an investment. We're not even telling you that you should invest money into the policy. We're telling you that it's a great place to store, save money, build up capital, and achieve things in life. It's probably the best place we know of to do that, and we have access 100% to it. We love what they allow. The policies free you up, allow you to do whatever you want to do, and the illustrations are just a piece for you to understand the product so you can best leverage it for you. Thank you for listening to this podcast on the topic when it comes to life insurance. Please, if you have questions, as always, reach out to us, comment on our post, DM me, email me. I want to help you learn this strategy and help you make the best decision on how to build it, how to use it, etc. So thank you again for supporting us. We'll see you in the next episode.